This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 10, 2026, and this is the Tokyo session. Now, let's get into it. Bitcoin is sitting at $64,000.20, holding steady despite the fear and greed index plunging to 14. That is extreme fear. Meanwhile, Ethereum is up 26%. Wait, no, that's wrong. Let me check the tape. Ethereum is up 2.6%, outperforming Bitcoin as capital rotates into infrastructure names. We are looking at a market where retail has completely checked out, but institutional flows are quietly rewriting the narrative around tokenization. Welcome to the pre-market briefing. Before we dig into the charts, let's look at what's on the calendar. There are no major central bank decisions or CPI releases scheduled for today, July 10, 2026. However, the market is pricing in structural shifts rather than macro data. The most critical event to watch is the PayPay initiative, which owns 40% of Binance Japan, seeking up to $1.1 billion in a Nasdaq IPO. That lands effectively now as a live development. Why it matters? It's a direct bridge between Asian retail liquidity and Western regulated exchanges. ApeX, does this change your view on the liquidity environment?
It reinforces the liquidity thesis, narrator. But don't mistake it for a short-term pump. This is about structural integration. PayPay going public creates a regulated conduit for capital that was previously trapped in offshore grey zones. It doesn't mean Bitcoin breaks out today, but it removes the capital flight friction we saw with Iranian outflows earlier this week.
Understood. So, structural integration over immediate speculation. Let's set the scene. We have a total crypto market cap of $2.28 trillion, up 1.63% in the last 24 hours. Yet the fear and greed index is at 14. Extreme fear. The VIX is compressed at 16.90, indicating low volatility in the broader equity markets, but inside crypto, the tension is palpable. Bitcoin is the anchor at $64,205, plus 2.19%. Ethereum is leading the charge at $1,792.87, up 2.60%. And then there's Uniswap, which has exploded 10.11% to $3.66. The divergence is stark. Pulse, walk us through the psychology here. How did we get to extreme fear when the candles are green? It's a textbook capitulation event masked as a rally. The fear and greed index has accelerated from 12 to 14 over the last 7 days. That rapid deterioration in sentiment tells me retail traders are getting shaken out. They're seeing the Iranian outflows spike 700% and the headlines about romance fraud recoveries, and they're fleeing. But they're fleeing into cash, not into shorts. The fact that the market cap is up 1.63% with $62 billion in volume means the sellers aren't finding buyers in the traditional sense. They're being absorbed by a different kind of participant. The retail mind is in survival mode right now, ignoring the structural wins because the noise is too loud. So the retail trader is scared, but the money isn't leaving the asset class, it's moving. CIPHER, who is buying, because Uni jumping 10% suggests someone knows something about the tokenization narrative.
It's not just Uni, though Uni is the poster child. Look at the cluster. Link is up 2.65% to $7.95. DART is up 5.96% to 0.8783. These are infrastructure plays. The headline from Cointelegraph about TD Securities calling NYSE tokenization an institutional turning point isn't marketing fluff, it's a directive. Smart money is rotating out of speculative retail bets, like ADA, which is down 1.28%, and NEAR, which is flat at minus 0.17%, and into the rails that will carry that tokenization volume. The flow is moving from hope coins to utility coins. The 10% move in Uni isn't random. It's a repricing of the decentralized exchange gateway as traditional finance enters the chain.
So we have a rotation from speculation to infrastructure. Let's drill down into Bitcoin first. Grid, give me the technical posture. Bitcoin is at $64,205. It's holding the line, but is it strong?
It's holding, but it's lazy. Bitcoin is exhibiting classic compression at 64K. The VIX is at 16.90, which is suppressed. In a low volatility regime like this, price tends to grind rather than explode. The key here is the lack of conviction in the derivatives market. Bitcoin futures demand has fallen to 2024 lows. That means there is no leveraged long squeeze risk, yes, but there is also no fuel for breakout. Spot buyers are absorbing the sell-side pressure, but without open interest expanding, any move above 65,000 feels fragile. We are seeing accumulation, but it's passive. The structure is neutral to bullish, but it's waiting for a volatility trigger to confirm the direction. Right now, it's just holding the fort.
I'd call it a trap grid. You're seeing passive accumulation, but I see a liquidity void. With futures demand at 2024 lows, the market is starving for engagement. When you combine that with Core Scientific's disappointing Q4 results, which dragged down the infrastructure sector, and the geopolitical risk of the Iranian outflows, you have a recipe for a sudden vacuum. If spot buying dries up even for an hour, that $64,000 support becomes a magnet for downside. The low VIX makes it feel safe, but it's actually making the system brittle. There's no cushion here.
That's a sharp contrast. SPECTER sees brittleness, Grid sees a pause. Pulse, does the sentiment data back up SPECTER's worry about retail exhaustion? Absolutely. The Fear and Greed Index at 14 is not a buy-the-dip signal for the average user. It's a get-out-while-you-can signal. When sentiment is this negative, usually the only way up is from the bottom. But here's the twist. The volume is $62 billion. That volume is keeping the price up despite the fear. So, while retail is emotionally broken, the transactional reality is that big players are stepping in. My read is that the fear is real, but it's priced in. The market isn't falling because the selling pressure has been exhausted. We're at a psychological floor. Okay, let's pivot to Ethereum. It's outperforming Bitcoin, $1,792.87, up 2.60%. CIPHER, why is Ethereum stronger right now?
Because of the CBDC ban in the Senate housing bill. This is a massive structural win for Ethereum's narrative. The ban removes regulatory overhang for decentralized finance. Combined with the Bitfinex tokenized bond launch, Ethereum is becoming the settlement layer for these new institutional products. It's not just a crypto coin anymore, it's the bond market of the future. That's why Uniswap, Chainlink, and Ethereum are moving together. They are the beneficiaries of the regulatory clarity. The flow data shows capital parking in Ethereum to capture the yield and governance rights of these new tokenized assets.
So Ethereum is playing defense and offense simultaneously. Defense against regulation via the ban, and offense via tokenization yields. Grid, technically, Ethereum is showing relative strength. Does the chart confirm the fundamental story?
Yes, Ethereum is breaking its own consolidation range while Bitcoin is ranging. The relative strength index on the Ethereum/Bitcoin pair is climbing. This confirms that the market is treating Ethereum as a separate asset class from pure store of value plays. The plus 2.6% gain against a minus 0.19% move in TRX shows that capital is actively rejecting stagnant assets in favor of those with active network upgrades and institutional adoption. The chart is clean. There's no overhead resistance immediately visible, which allows the momentum to continue without the friction we see in Bitcoin.
Clean momentum. Now, let's look at the outlier. Uniswap. It's up 10.11% to $3.66. This is the biggest mover on the board. CIPHER, what is happening with Uniswap?
Uni is riding the coattails of the TD Securities announcement. As the largest decentralized exchange, Uniswap is the primary gateway for tokenized securities entering the blockchain. When traditional banks want to trade tokenized bonds or stocks on-chain, they go through Uniswap's liquidity pools. The 10% jump is a repricing of Uniswap's monopoly power in this new era. It's not just a decentralized exchange token. It's a financial infrastructure token. The volume spike confirms that large wallets are accumulating before the full rollout of these tokenized products.
And that's where I see the risk. 10% in a single day on a narrative play is dangerous. You're describing a speculative frenzy disguised as fundamental adoption. If TD Securities delays or faces regulatory hurdles, that 10% gain vanishes instantly. Also, look at the broader market. While Uniswap is flying, Cardano and NEAR are red. Capital is concentrated in very few pockets. If the Uniswap trade unwinds, it won't just hit Uniswap. It'll drag the entire decentralized finance sector down because the liquidity is so concentrated there. The low futures demand we talked about earlier means there's no buffer. If Uniswap starts rolling over, the lack of leveraged support could cause a cascade.
A cascading risk in decentralized finance. Interesting. Let's touch on Solana. Solana is at $78.85, up 1.24%. It's green, but it's lagging behind the infrastructure giants like Uniswap and Chainlink. ApeX, where does Solana fit in this new tokenization world?
Solana is still playing catch-up. The current narrative driver is institutional turning points, and that language is tied to NYSE and traditional banking rails, TD Securities, Bitfinex, PayPay. Those institutions are building on Ethereum and Layer 2s, or perhaps Hyperledger, not necessarily Solana's EVM-compatible sidechain right now. Solana is seeing a mild bounce because it's undervalued relative to its throughput capabilities, but it lacks the direct headline catalyst that Uniswap and Ethereum have. It's a beta play on crypto generally, not alpha on the specific tokenization theme dominating this session.
Technically, Solana is consolidating below $80. It needs to reclaim the $80 psychological level to match the energy of Ethereum. Right now, it's stuck in the middle. The volume isn't there to push it through. Until we see a break above 80 with expanding volume, Solana is just treading water.
Sentiment-wise, Solana is fine. It's not feared like the older alts, nor is it adored like the new tokenization plays. It's in the wait-and-see zone. Retail isn't piling in, but they aren't dumping either. It's a neutral sentiment pocket while the market fights over who gets the institutional mandate. Neutral? Okay, let's broaden the scope to the laggards. XRP is essentially flat at $1.11, up just 0.96%. Cardano is down 1.28%. Why are these legacy assets struggling while Chainlink and Polkadot surge?
Because LAGPA legacy large caps don't have the tokenization hook. XRP and Cardano are seen as payments or general-purpose chains, but the current institutional demand is for programmable finance, bonds, treasuries, structured notes. Chainlink provides the Oracle services for that data. Polkadot provides the interoperability. XRP and Cardano don't have a clear, announced partnership with a Tier 1 bank for this specific wave. The capital is flowing to the shovels of the gold rush, not the gold itself. Without a specific catalyst, like the TD or Bitfinex deals, XRP and Cardano are just competing for residual liquidity.
And let's not forget the headline about U.S. authorities recovering $327,000 in ETHUSD from a romance fraud. That's a reminder that regulators are still cracking down on stablecoin abuse. XRP often thrives on the promise of seamless fiat settlement, but if the regulatory spotlight is on fraud and recovery, that's a headwind for any asset promising easy money without rigorous KYC/AML integration. The market is punishing assets that feel loose and rewarding those that feel compliant, like the new tokenized bonds.
Compliance is the new currency. Let's look at the final piece of the puzzle, the geopolitical risk. The Iranian crypto outflows spiked 700% after U.S.-Israeli airstrikes. How is this impacting the broader market, especially Bitcoin? It's adding to the noise, but it hasn't moved the needle on price yet. The spike in outflows suggests capital is fleeing Iran for crypto assets, likely Bitcoin or stablecoins, to escape sanctions. This adds to the spot buy pressure for Bitcoin, which might explain why Bitcoin is holding 64K despite the fear. But it's also a regulatory landmine. Any news linking Iranian funds to exchanges could trigger delistings or freezes. The market is watching this closely. It's a shadow over the whole industry.
From a chart perspective, the lack of a crash despite this headline confirms the strength of the buyer base. If the market were weak, the geopolitical scare would have triggered a stop-loss cascade. Instead, Bitcoin held. That suggests the institutional bid is strong enough to absorb geopolitical shockwaves. The support at 64K is real.
Or it's a delayed reaction. Geopolitical shocks rarely show their full effect intraday. They linger. If the headlines escalate over the weekend, Monday's open could see a violent repricing. The fact that VIX is low right now gives us a false sense of security. The fuse is lit.
A lit fuse, very clear picture. We have institutional accumulation driving Ethereum and infra up, retail fear keeping Bitcoin steady but capped, and geopolitical risks simmering in the background. Let's wrap this up. ApeX synthesize the scene. What is the dominant thread?
The dominant thread is structural shift over speculative mania. We used to have rallies based on hype. Today we have rallies based on policy, CBDC bans and partnerships, TD Securities, pay. The data shows that Bitcoin is holding, but the alpha is in the infrastructure. Uniswap, Chainlink, Ethereum. The extreme fear of 14 is a distraction. The real story is the quiet migration of capital from meme coins and legacy alts into the rails of the new financial system. However, SPECTER is right to warn about the low futures demand. This rally is SPART funded. If SPART demand wavers, the structure is thin.
Agreed. Just remember, the fear is real for the people holding the bags. Don't confuse the institutional flow with retail happiness. The retail trader is still scared, even if their portfolio is barely down.
And technically, watch the VIX. If it stays below 17, the grind continues. If it pops above 18, expect a volatility spike that tests the 64K support hard.
Solid warnings. Here's your takeaway for today. First, the market is decoupling from retail sentiment. Fear is high, but price is resilient due to institutional inflows. Second, the leadership is shifting from broad beta assets to specific infrastructure plays. Look to Ethereum, Chainlink, and Uniswap, which are benefiting directly from the tokenization narrative and regulatory clarity. Third, caution is warranted. Bitcoin's advance is spot-driven with minimal leverage, making it susceptible to liquidity dry-ups, while geopolitical tensions remain a wildcard that could disrupt calm. Tomorrow, watch for continued volume in the tokenization names and monitor whether Bitcoin can maintain the $64,000 level as the weekend approaches. I'm your narrator for ShadowQuant Crypto Edition. Stay disciplined. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.